Welcome back to another episode of Finance by David. Today I'm going to be talking to all the loan officers and I will be teaching you how to pre-approve a borrower. We're going to break this down into 3 steps. The first one is you want to make sure you gather all of your borrower's documents and take your 1003 application. They're going to need their ID, Social Security card for FHA loans, pay stubs for the last 30 days, W-2s and tax returns for the last 2 years to verify the income. The tax returns must be personal and business tax returns if the borrowers own any businesses. Then the bank statements for the last 2 months, all pages. Sometimes borrowers like to block out some information or just send you the first page. Remember, you need all pages. No information can be redacted or blocked off. If the borrowers own a mortgage and they're trying to refinance, or even if they're trying to purchase, you're going to need the mortgage statement if they have a mortgage on that real estate, the fire insurance as well, and if the property is leased, the lease agreement as well. The next step, once you've gathered your 1003 and all the paperwork, then you're going to go ahead and run credit and analyze the income. So when you run the borrower's credit, you're going to see if the FICO score is eligible for your loan product. FHA and conventional have different FICO score requirements. And you're going to see the history and trade lines. A borrower might have a good credit score and good history, but they might have a bankruptcy a couple of years ago that does not allow them to get financing. Make sure you look at the FICO score and the history as well. Next, you're going to analyze the income. That's part of analyzing the borrower's overall creditworthiness. When you analyze the income, you don't only take the monthly income. You're calculating the income wrong if you do that. You have to average out the borrower's income for the last 2 years, and that's usually the income the underwriter is going to credit the borrower. Some conventional loans, when you go to an LP product versus going DU, will allow you to qualify with 1 year of tax returns. So in that case, you can average out last year's tax returns and this year-to-date tax return and go ahead and still qualify with that income. So depending on the loan product your borrower is qualifying for, will determine if you average out your income for 24 months or last year plus year-to-date. Once you've run the credit and analyzed the income, now you know how much a borrower is going to qualify for. Because each loan product has different debt-to-income ratio requirements, for example, FHA ratios are usually 46.99% front end and 57% back end, and conventional loans are usually 45% front end and 50% back end. Once you've analyzed your credit and your income, that will tell you how much a borrower can qualify for, mortgage payment wise. After analyzing the credit and the income, you want to analyze the bank statement. Just because a borrower has the money in the bank doesn't mean you can use that money to buy a home. In order to avoid money laundering, the underwriter will check if there are any large cash deposits. Pretty much anything above $500 is going to qualify as a large cash deposit. So make sure that the borrower has seasoned funds. If they have mattress money, they have to start depositing the money into their bank account so that they can use the funds, or educate them on using a gift, and a donor can help them with that money if they're buying a primary residence. This is a very important piece. They cannot just walk into the bank with bills, deposit money, and expect to use that for their down payment. Not with mortgages. So educate your borrowers accordingly with the asset piece. That's the last piece of analyzing a borrower's credit worthiness. You review the credit piece, the income, and the assets. You already should have inputted this data into your Encompass or point system, and this will tell you your borrower's ratios, and you can start playing with the purchase price and adjusting it higher or lower, so that way you can know if they qualify for the purchase or refinance. The third step in pre-approving a borrower is either approving them or denying them. If you approve a borrower, make sure you issue a pre-approval letter that's eligible for 90 days and your loan estimate as well. Usually you're going to want to attach the borrower's FICO score, redact any personal information, and the first page of the borrower's bank statement from where the down payment is coming from, so that the realtor can attach that to the offer that they're submitting. And if they don't qualify, you simply deny them and let them know they're not eligible and give them a game plan of what they need to do. Either they have too much debt or they need to make more money, usually is the case. And if they don't have any debt and they make a good income, then they need a budget so that they can start saving some money to qualify. Or look for a down payment assistance program. In some states, borrowers are eligible for down payment assistance programs. Thanks for tuning in, and see you at the next show.